Palantir stock jumping nearly 20% higher following their fourth quarter 2022 earnings results. CNBC is reporting about how Palantir just reported their first profitable quarter. Alex Karp, the CEO, founder of Palantir, emphasizing this point. Palantir is profitable. This is a significant moment for us and our supporters. In all honesty, as I look at Palantir, I personally think that this was an unbelievable quarter, the way they're framing this. And I'll talk about that in just a second. What do I mean by unbelievable? What do I think about their profitability now? What do I think about Palantir's valuation? We're going to talk about all this and more. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that subscribe button. So let's dive into this unbelievable quarter for Palantir. So management talked about how they were profitable. I did a quick search. They mentioned profitable 20 times. So Alex Karp is super excited to be profitable. He goes into a whole question, why, if you're so good, why aren't you GAAP profitable? Well, now we are GAAP profitable and we plan to be GAAP profitable this year. So generally accepted accounting principles. So look how great we are. Our company's profitable. Mentioning it 20 times on the conference call. I mean, they must be incredibly profitable after, mentioning it so many times. So let's actually look at the results, because I'm the type of person that says, okay, that's nice, but trust, but verify. Let's actually make sure that this is legitimate here. So let's look at the results. So they generated $30 million in net income. Okay. If you want to learn how to read financial statements yourself, I did recently launch 2 educational courses, one on how to think about valuation and one how to read financial statements. So let's do an example right now. So they did $31 million in net income. Okay. So yeah, they generated, and 1 cent earnings per share. That's better than nothing. I mean, it's still profitable. I mean, 30 million versus a multi-billion-dollar market cap does strike me as a bit rich, but let's understand where this $31 million in profits came from. So as we move up, we see that there's $44 million in other income, which, I'll cut to the chase, came effectively from an accounting treatment where they have a joint venture, Palantir Japan, that they consolidated. So what they own, they're now acquiring the rest, and therefore what they previously owned gets marked up. At least that's my understanding of it. Not really a big cash driver, just saying, hey, we're consolidating segments. Really an accounting move. This isn't like core profitability, hugely profitable, core segments, hugely profitable. No, this is an accounting adjustment for $45 million. And interest income, so really you get 13 million from interest income from their huge cash balance, because they have a couple billion in cash. But their loss from operations, so their actual business, is still unprofitable to the tune of $20 million. So, I look at this and I'm thinking, we should really be thanking Jerome Powell. Like, thank you, Jerome Powell, because, your interest income of 13 million is over half of the loss that you are generating from this period. And the rest really comes from an accounting adjustment for your joint venture. So this is just absolutely unbelievable that management would go all in on this. Oh, we are profitable now, and mentioning it 20 times on the conference call. This is absurd to me. Like, this is the exact opposite of the understated management that delivers time and time again. This is the management that overpromises and underdelivers. That's what they've done so far. And this is like classic playbook. Like, literally 2021, Alex Karp was saying we're going to grow at 30% plus for the next 5 years. And we're going to talk about that growth in a second. Compare that to a really successful CEO, someone who's proven themselves with getting real shareholder returns over time. Someone like Warren Buffett. He's made a point. If you look at Berkshire's results, I've done videos on Berkshire's results. He's made a point that he tries to back out the volatility in his investment portfolio when he's reporting earnings, because he's like, that's going to create a lot of noise versus focusing on what's my actual performance. In some years, that's like $100 billion gain for him. He doesn't go, booyakasha, $100 billion man. He doesn't do that. I mean, it's absolutely absurd. Like, if he had Alex Karp energy, that's what Warren Buffett would do. And he'd have like crazy color shirt on. He'd puff out his hair and he'd go $100 billion. Booyah. That's what Warren Buffett would do. But no, Warren Buffett's a baller, so he doesn't have to do that. He's not a poser. And that's what I'm thinking when I'm looking at this. Like, I'm thinking this guy is overpromise and underdeliver. That's at least, who talks about profitability? You got 1 cent a share. This is unbelievable to me. Now, okay, I might be a little too harsh here, because the reality is they are delivering important things for the world. They are a force for good. That's my impression, and I'm glad they're around. I'm glad they're launching products and helping countries and businesses out, Western countries. They talked about how in 2022, our software foiled a plot to overthrow a German government, delivered several $100 million of savings for Tyson Foods. People like their chicken nuggets. And you can look at their revenue for commercial businesses. And historically, yes, Palantir was, and is currently driven primarily by government contracts. But you can see that commercial business has been growing at hyperscale from, under 40 million in revenue to, over 300 million over the last 5 years. So they clearly are resonating from a corporate perspective as well. So that's what I like to see. And so despite, what I've talked about, sort of saying overpromise, underdeliver, like what they've done, there is real meat to the bone here of offering a real product that people find useful. But there's a difference between having a great product and, and delivering real value to customers and actually generating attractive shareholder returns in an honest way and in a straightforward way. And that's really what I'm harping on here, which is like, hey, there's a way to do business, and this isn't it. That's my opinion, at least. And so looking at the results, once again, you don't really, it's very downplayed. You don't see this really in their presentation materials. They focus on the annual details, but you look at their results and it's not crazy impressive given, the hype that has been around this name. I mean, once again, previously management in 2021, this is literally from their press release at the bottom here, per long-term guidance policy provided by our CEO, Alex Karp, we continue to expect annual revenue growth of 30% or greater for 2021 through 2025. So fast forward to 2022, 2 years into this forecast, total revenue grew 18% in the fourth quarter, so way missing. And you're looking at commercial revenue growth of only 11%. And that is a little bit concerning to me. I've had some conversations with various different insiders in terms of the security industry, and they suggest that Palantir isn't as unrivaled as, they'd like you to believe. And so this is one of these data points where I'm looking at this and I'm thinking, I want to see the commercial revenue grow at a faster clip for me to believe like this is truly, revolutionary and truly going to have that 20 to 30% growth in the years ahead. And so when I see commercial revenue growth of only 11%, sure, it's a tougher economic environment, but there are some software companies growing much faster than that. And so that it does make me wonder if the competitive environment for their data analytics plus AI, suite is effectively being challenged. Are they as special as they think that they are when your commercial revenue is only growing 11%? Or is it just a problem of getting to market? So these are real data points to see, and we'll see how it plays out. So what do I think about Palantir from here, given their recent results? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. In full disclosure, this is not financial advice. And so when I look at Palantir, once again, I do think what they do and provide is valuable for many, many customers. I think these are important tools for societies. I think these are important tools for businesses, and I'm excited to watch them grow in the years ahead. That doesn't necessarily mean that shareholders are going to have a great ride. So I want to see better execution. When I look at their execution and this company talking about their growth, this company needs to get a better handle on their shares and their dilution. Because when you're talking about even the 18% growth that they talked about, when you adjust it for their growth in diluted shares, which went from 2 billion to 2.2 billion, their revenue per share, and by the way, I talk about this in my valuation course, you need to focus on what's effectively your free cash flow per share over time and how that's performing. That's really like the key golden metric. Like it comes down to what's the value per share this company is generating to you. And the per share part is like per slice of pie. And when they, obfuscated, oh, look at this growth rate, 18%. But then you look at it, and on a per share basis, you're only growing 7%. That is really, really underwhelming, especially for a business that I'd argue is still unprofitable on their core basis. Now, hopefully, management's right and they actually do deliver on being actually profitable. Maybe a good chunk will come from Jerome Powell and their interest income. I mean, by the way, now you can get over 4%, back on your cash balances at Interactive Brokers. That's where I keep my, investment accounts at Interactive. There's a link below if you're interested. And so I look at this 7% growth revenue per share. I'm just not impressed at all. And once again, looking at, their stock-based compensation, it just doesn't strike me that they've got it under control. For a full year basis, yeah, sure, it's down a bit from nearly 800 million to a little under 600 million. That's just a boatload. And that's all of their operating profitability. All of their operating cash flows, I should say, comes from that. So I'm just, they need to get a handle on this, because there's a big difference between delivering quality results for customers versus delivering quality returns for shareholders. And that's my concern here. Now, what's management guiding to? Management's guiding to around 17% revenue growth, around 2.2 billion in revenue for the year. GAAP net income being very, very vague here. GAAP net income, isn't that wonderful? This 2.2 billion in revenue makes me think, given you're going to continue to have sizable share dilution, I expect that their revenue growth on a per share basis might be closer to 15%. We'll see. I mean, maybe they're finally getting their act together and saying, oh, okay, we're going to actually, deliver better than we guide to. Maybe that would be the case. So in which case, maybe they could do better than this. We'll see. We'll see how they perform. So when I think about this from a hypothetical valuation framework, of course, stock price can go way higher, way lower. I'm thinking about these different components. So 1.9 billion in revenue last year, guiding to 2.3 billion this year. I'm giving them more than benefit of the doubt. I'm saying they do better than what they're guiding to. And I'm assuming long-term, they're actually able to get to 20 to 25% margins. Once again, they're nowhere near that right now. But given that they do have 80% gross margins, I would suspect that they could do this over time. Looking at that, trading around, let's say, 50 times earnings, for a company growing at 20%, assuming they continue to grow that way on a diluted basis in the years ahead. Keep in mind, they're not doing that right now. And then 5 years out, some 20-something multiple, add back the sizable cash that they have on their balance sheet, which comes from diluting shareholders, selling a part of the pie each year. And I'm getting, effectively shareholder returns that really aren't compelling. Nothing to write home about. Like maybe the stock's flat over the next 5 years. Maybe it's up 50%. Once again, stock price can go way higher, way lower. It depends on the execution. Will they deliver? It depends on sentiment. Will, Wall Street give it a higher multiple? I just personally look at this, and I have two thoughts that it comes down to with Palantir. One is I think about Amazon. Amazon was the hype stock of the .com bubble. I think Palantir was like was like similar to Amazon in terms of the hype that you saw in the most recent bubble. And what happened with Amazon post-pop is that it went nowhere for several years, where it sort of was range-bound for 2, 3, 4 years. I sort of expect that you're going to see something similar with Palantir, where maybe it pops up into low teens and then it bounces around between teens and, mid-single digits for a couple of years. That would be my personal expectation, based on at least how they're delivering and sort of this framework thinking about valuation. I personally also think that they're just better plays out there. Palantir's talking about 7% revenue per share growth. And, I own a payments company. I call it out to my subscribers at Unrivaled Investing. I purchased it over the last few months, and they recently grew their earnings per share. So real earnings per share, that's, close to their free cash flow, growing at like 20%. And so I look at that adjusted earnings per share growing at like 20%. And by the way, it trades at like around 16 to 18 times earnings versus something like Palantir, which is like, oh yeah, it trades at like crazy multiple that they haven't achieved because they have this zany CEO that's, oh yeah, we're so great. Like we're so profitable. So I would just personally, on my investment journey, I'd rather have the understated CEO that delivers than the overstated CEO that doesn't. That's really what it comes down to. I want execution, not a fancy story. You know, if I see a company quietly delivering results, 10, 15% growth each year, that's what I want to see at a reasonable multiple. When I see an unreasonable multiple and not delivering, no thank you. If this video talking about Palantir has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in. I'd love to hear your thoughts in the comments below if you think I'm right or wrong. Thanks so much for tuning in.